Be Wealthy and Smart, episode 1159.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about all of this stock market volatility that we've seen lately. What's causing it? Where are we going? What's really happening? Because I don't think the real picture is being shown. I think there's a lot of emotion, there's a lot of misconstrued economic data that is very confusing, but we're going to sort all that out today, and I'm going to show you clearly what's happening. Because I think the big message here is that a lot of economic indicators are lagging indicators. That means they're showing us old information. They're not showing us the current picture. So when we get economic news, we have to realize this is from a period in the past. It's not showing us what's currently going on, nor is it a leading indicator. Leading indicators look into the future and tell us where we're going. Now, before we talk about the economic indicators that came out today, I want to also point out that we have a lag when the Fed raises interest rates. So when the Fed raises interest rates, there's a lag time between when those interest rates start to slow down the economy. And because the Fed raised interest rates so quickly and with big 50 basis point hikes, half a percentage point hikes, starting in March of 2022, that has not given us time for us to really feel the effect of the rise of interest rates. We all know that how that's affected the housing market. We all know that that's slowed people from purchasing homes, but yet we're still getting indications that inflation is running hot, which is one of the things that happened today, is that the data came in a little bit stronger than expected for inflation. Now, most of the higher inflation that we're seeing is in energy and in food prices, and raising interest rates isn't going to bring down energy and food prices. In fact, it's going to make energy and food prices more expensive in most cases. But what raising interest rates does is stop big ticket purchases. So it stops housing, it stops new car sales, it stops the bigger priced items, the more expensive items that you were intending to purchase. And there's evidence now that 40% of consumers are having a difficult time paying their bills. So for 40% of Americans, it's very difficult and things are not good. But again, that's not showing up in the economic data. So what was the data that came in today that got the stock market all jittery? It was the Personal Consumption Expenditures Price Index. It increased 0.6% for the month, which was up 4.7% from a year ago. Now, Wall Street had been expecting about 0.5%, so 0.6% was a little high. And it was also expecting 4.4% for year over year, and we got the 4.7 number. And the reason why that spooked the markets is because if inflation appears to be running hotter than people think it is, that means the Fed may have to raise rates longer and higher. And so what the bond market did was it readjusted its expectations as a result of these numbers. And instead of just a hike or two, it projected in 3 25 basis point or 0.25% interest rate hikes at the next 3 Fed meetings. So we had 2 hikes built in, now we have 3 hikes built in. So the bond market is saying that interest rates will go 0.75% higher this year. That's really the background of everything that happened today. Now, I told VIP members that the first quarter was going to be very difficult and we were going to have to endure and get through the first quarter volatility. This is where I see that we're back and forth in a transitioning process and we haven't had enough time to let the Fed rate hikes work its magic yet, or its slowness yet, if you will. And that is going to take time. I don't think we're going to see how obvious it is that inflation is under control until about June. And then it's going to be very apparent that inflation has slowed quite a bit. But I do think the October lows have a very good chance of holding, and we may go down and test those lows. But remember, we had the strongest 3-month rebound ever in history in the stock market in the last few months. So we had this super sharp recovery. It's natural that we're going to have some sell-off from there and some profit taking. But this is the thing. I think there's a lot of fear in the markets because some people feel we haven't seen the bottom. And if we haven't seen the bottom, that means that they think inflation is still on a runaway train, basically, and that we're going to have a lot more rate hikes than we were expecting. I just don't see that that's the case. And these are the reasons why. First of all, we know that unemployment is at a 50-year low. The consumer's employed and the labor market is the strongest since 1969. Now you may say, well, doesn't that support the case that the economy is too hot and we're going to have to raise rates more? But I'm going to argue that no, all that that's telling us is that we're going to be able to maintain somewhat of a healthy economy through this whole situation because we have people employed. People are employed, but remember, those who rent are having to pay higher rents. People who commute to work are going to have to pay higher gas prices. And so people are employed, but their expenses are higher. Food prices are up. They're paying more just to live their everyday lives. So to me, they're not necessarily going to be making big purchases. That's going to slow, but it helps us get into the soft landing camp that we are going to be able to not have the economy contract. The second positive thing we have going for us is that inflation has been trending lower and that the peak of inflation seems to be behind us, which was last year. We're also closer to the end of interest rate hikes than we were to the beginning of hikes. And these quarter point hikes, 2, maybe 3 in the future, are smaller hikes than what the Fed did last year, and we're getting to see an end coming soon. Another reason I'm optimistic is that Chairman Powell used the word disinflation 13 times in the December report, indicating that that is a trend and that that is on their radar and we are seeing disinflation. And finally, as I said, the economic effect lags interest rate hikes by several months, so it's likely we'll eventually see a bigger retreat in inflation than people are currently expecting. Volatility is never fun, but the worst thing you can do is try and time the market. I really think that once we get these interest rate hikes done, the market is due for a massive rally once that happens, and potentially we may even see that once inflation comes down more than we were expecting because of that lag effect, that we may even see the pause or even a cutting of interest rates in the second half of the year. So I think there's some good news out there later on, but we have to make it through this first quarter, which is extremely volatile. But if you tried to time the market and you just missed the 10 best days in the stock market in the last 20 years, your return would have been reduced from an average of 10% to a negative 2.8% average. And that's why we don't try and time the market. We don't try and go in and out. We don't try and make short-term profits. We don't try to avoid downturns. We realize that these downturns are part of investing and they happen on a regular basis. And they're never fun, but the worst thing you can do is react to them and to do something drastic to your portfolio. You don't want to panic and sell. Your portfolio will also recover the fastest if you remain invested during the sharp bounces, because we have these sharp rebounds like we had over the last 3 months. That is what is going to get your return back and have you make up the money from this correction. But if you go to cash, you miss that rebound and you're missing the gains that your portfolio is going to realize. Holding and not selling is your best strategy, even though it feels scary. And remember, the second year of the decade is often the lowest point in the stock market for the entire decade. It's not always true, but more often than not, it has been true. If we look back to 1922 and that low, the stock market recovered from 1922 until 1929 500%. Because of the technological revolution and the quantum age that we are experiencing right now, I think it's quite possible that kind of a cycle, a very similar cycle of upward growth for this decade, could be in our future. So hang in there, we'll get through this, and better days are ahead. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all of my podcasts are on my website at lindapjones.com/podcasts. There's a search box there, and you can search for any topic that you want to know more about in my wealth mentoring library. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.